If you've ever gone through a bankruptcy or even a foreclosure in the past, you're probably wondering, can I ever buy a home ever again? Or how long do I have to wait to buy a house? And for first-time homebuyers, you might be asking yourself, what happens if I ever go through that? And by the end of this video, you'll know everything you need to confidently move forward with buying a home after a bankruptcy or foreclosure using an FHA loan. Whether you're a first-time buyer or someone looking for a fresh start, this video will help you understand exactly how long you need to wait, what lenders look for, how to rebuild your credit, and how to put yourself in the best position to get approved. There's no fluff, no confusion, just clear step-by-step guidance to get you back on track towards homeownership. Hi, I'm Alex Ramirez, and I help first-time buyers and step-up buyers navigate the mortgage process with confidence. And don't forget to like, subscribe, and tap that bell so you never miss any of my weekly updates in the future. Now let's dive in. So what's an FHA loan? Before we talk about all the waiting periods, let's make sure we're on the same page. So an FHA loan is a government-backed mortgage. It's insured by the Federal Housing Administration and is designed to help people with lower credit scores, less money for down payments, or people who've had financial setbacks. And the beauty of FHA, it's forgiving. It's one of the few loan programs that allows you to buy a home even after a bankruptcy or foreclosure, as long as you meet the waiting periods. Many buyers assume their credit history disqualifies them forever, but FHA was built to support buyers who are rebuilding. Whether you're coming out of rough financial patch, medical crisis, or just trying to start fresh, FHA offers flexibility and structure. It's a first step for many who thought homeownership was out of reach forever. The FHA program also allows for more flexible debt-to-income ratios, more lenient underwriting, and in many cases, lower interest rates than conventional options. Plus, the minimum down payment is just 3.5%, and that can often come from a gift or down payment assistance. That makes FHA one of the most accessible paths to home ownership around, especially for those coming off a tough financial season. So let's start with bankruptcy first. There are two common types of bankruptcy that FHA guidelines deal with. So Chapter 7 bankruptcy, that's a liquidation of all your debts. So the waiting period is 2 years from the discharge date. If your bankruptcy was discharged on March 1st, 2022, you'd be eligible for an FHA loan starting March 22nd, 2024. You must also show that you've reestablished your credit and haven't had any late payments since then. The bankruptcy must be fully discharged, not in process. Chapter 7 is a clean slate, but lenders want to see what you've done since. Have you kept your credit cards low? Have you avoided new derogatory accounts? These are signs of financial maturity and make you more attractive to lenders. FHA wants to ensure the hardship was temporary and not ongoing. And if your income has increased, your employment is stable, and your housing history is solid, that all works in your favor. Most underwriters will look at the big picture, not just the bankruptcy itself. Think of it as your comeback story, and the cleaner your credit habits post-discharge, the better your chances. And let's go over an example to help you understand this a little bit better. So Ashley filed Chapter 7 after unexpected medical bills. Her bankruptcy was discharged in April 2021. By May 2023, with no late payments and a new credit card in good standing, she was approved for an FHA loan. Example 2, Marcus filed Chapter 7 after a business failed. His discharge was July 2020, but he had multiple late payments in 2021. He was not approved until mid-2023 due to poor reestablished credit. The other bankruptcy is Chapter 13 bankruptcy. It's a reorganization. You can qualify while you're still in Chapter 13, but there are a lot of details to it. You must have made at least 12 on-time payments and get written permission from the court. And you have to get this after discharge. There's no FHA mandating waiting periods on this, but lenders typically expect reestablished credit and stable financial patterns before getting this approved. So Chapter 13 shows a willingness to repay, which lenders and FHA both respect. If you're still in your plan, your mortgage lender will work with your trustee to get the approval. It's a team process, but many borrowers are surprised this is even an option. Chapter 13 also gives you time to rebuild your financial habits slowly. The lender will look for consistency in employment, steady income, and solid credit habits. You may also be asked for letters of explanation, bank statements, and budget plans. So be prepared to show you're financially disciplined. So example 1, Jasmine is in year 2 of a 5-year Chapter 13 plan. She's made 24 on-time payments and received court approval to purchase a home. She was able to buy a townhome using an FHA loan. Example 2, Eric finished Chapter 13 in March. Since his discharge, he's kept his credit clean and saved a 3.5% down payment. He was approved in less than 30 days. And if you're ready to take action right now, don't hesitate to reach out to me, call me, or text me. My number is going to be right here on the screen, or go to my description and set up a discovery call. I'll be more than happy to talk to you and put a plan together and get you into a home. So let's go over FHA and foreclosure. A foreclosure is when the bank takes back your home because you were unable to make the mortgage payments. So the FHA waiting period for foreclosure is 3 years from the foreclosure sale date. And this is critical. It's not the date you moved out or stopped paying. It's the sale date when the bank sold the home. You can usually find this in the public county records of your credit report, or go to public records that are posted with the county. Foreclosures can stay on your credit for up to 7 years, but that doesn't mean you have to wait that long to buy again. FHA offers a clear path at 3 years. Assuming you've already improved your financial habits, lenders want to see that you've already learned from the situation and save responsibly and stabilize your income. The lender will also verify that no new housing related derogatory marks have occurred since the foreclosure. This includes evictions, collections from landlords, or unpaid rental debts. They want to know that your housing situation is now stable and very well managed. So example 1, Natalie lost her home in 2020 during the pandemic. The bank sold it in December 2020. By January 2024, she's eligible for an FHA loan and has saved 5% down. Example 2, David stopped paying in 2018, but the foreclosure didn't finalize until 2021. His waiting period started then, not when he moved out. He'll be eligible in 2024. If you had both a bankruptcy and a foreclosure, FHA uses the event that happened last to start the clock. So what counts as a foreclosure? Does a short sale count as a foreclosure? Short sale will usually be treated like a foreclosure. There's a 3-year wait. Lenders will look at your credit history around the time of the sale. FHA sees short sales with no lates as a sign of responsible resolution. But if there were missed payments or it followed a hardship, it will likely be treated more strictly. Also, if you attempted a deed in lieu or the property was surrendered during bankruptcy, similar waiting periods apply. Always check your public records and final documentation. Your lender can help you sort through the timeline. Example 1, Brian sold his condo via short sale in 2019 with no missed payments. He qualified for an FHA loan in 2020. So example 2, Monica missed 5 payments before her short sale in 2020. Her FHA clock started in 2020 with a 3-year wait period. So what's an extenuating circumstance? FHA can reduce waiting periods if you had an extreme hardship outside of your control. Here are some examples: major medical emergency, death of a primary wage earner, a natural disaster, and you must fully document the event and prove it was truly a one-time event. A divorce, job loss, or overspending are not valid reasons. The review process is very strict. Underwriters need to see a paper trail, medical records, death certificates, FEMA declarations, etc. You also need to show a clear recovery, job reestablishment, stable credit, and current income. The earlier you begin gathering this info, the better your chances of being approved for a shortened waiting period. So example 1, Carla's husband passed away suddenly and she couldn't keep up with the mortgage payments. FHA approved her after 1 year. Example 2, John had a stroke and went into Chapter 13 with medical documentation. FHA let him purchase 14 months after the discharge. Okay, so how do you get ready? If you're still in the waiting period, here's what you can do. Rebuild your credit, so pay on time, do automatic payments, and use your credit responsibly. So check your credit report regularly, verify all derogatory marks are accurate, make sure there's no inaccuracies, and save money. FHA requires 3.5% down payment plus closing costs. And of course, talk to a lender. Start 6 months before your eligibility date. Get yourself prepared. Planning ahead helps avoid surprises, and lenders can help catch issues that you may not see. You'll also have time to improve your score and qualify for better interest rates. Preparation equals power in the process. Example 1, Luis started planning 6 months early and caught a mistake on his credit report that took 60 days to fix. Example 2, Tasha saved $12,000 over 18 months by cutting expenses and setting up automatic transfers. She covered her down payment and closing costs without any help. Okay, let's talk about the role of manual underwriting. I've covered this in other videos I posted on my channel. If your loan doesn't meet the automatic approval requirements, your file may go through a manual underwriting. This isn't bad. This could actually be really good for you and get you into a home. This means a real underwriter, an actual human, evaluates your file based on income, savings, credit history, and overall stability. Manual underwriting requires more documentation. You may also face lower debt to income limits and stricter credit requirements. But if your financial habits have improved, you have a solid chance of an approval. So example 1, Tony's score was below 640 after his Chapter 13. With strong income and reserves, he was approved manually. And example 2, Rachel had no credit since her Chapter 7. She added a secured card, waited 6 months, and her manual underwrite was approved, so she got into her home. And here's some common mistakes to avoid in the process. What not to do if you're planning to buy after bankruptcy or foreclosure. Let's get into that. Don't open too many new accounts all at once. And don't co-sign on loans or finance large purchases. And also don't ignore small collections or utility balances. Make sure you take care of that. Also, don't assume the waiting period is shorter than it really is. Always check official court records or trustee letters for the actual discharge or sale date. You could also communicate with your loan officer and they'll give you all the details for that. So example 1, Brian assumed his foreclosure date was 2019, but it sold in 2020. He had to wait an additional year. And example 2, Leslie opened 4 new credit cards too quickly. Her score dropped and delayed the approval process. And if you want me to run your numbers and see what fits your budget and your timeline, we could build a plan and put something together for you. Reach out to me. My phone number is going to be right here on the screen, 805-857-3708. Or you can click on my description and click on my Calendly and schedule a discovery call, and we'll go over all the details. So what lenders look for in a post-hardship? Once you're eligible, lenders look at the full financial picture. So steady employment, so at least 2+ years. They're gonna wanna see active trade lines, 2 to 3 minimum, and also a clean rental history. Emergency savings, so any type of savings or even money in a 401k account or a retirement account. This is how you move from being eligible to actually getting approved at a good rate. So here's another example. Serena had 1 trade line post-bankruptcy. Her rate was higher and she had to refinance later. Example 2, Frank had 3 trade lines, solid income, and $5,000 saved. He locked in a great rate and closed quickly. And the impact on credit and how to improve. Bankruptcy and foreclosure can lower your credit score by 100 to 200 points or maybe even more, but they don't hold you down forever. With time and good habits, your score can recover. To improve your credit, this is what you're gonna wanna do. Keep your balances below 30% of the limit. Pay everything on time. I recommend doing automatic payments. Also, use credit builder loans or secured credit cards. And don't apply for too much new credit all at once. Take your time. Example 1, Amanda opened a secured card and paid perfectly for 18 months. Her score jumped from 540 to 660. And example 2, Kevin ignored credit after foreclosure. Once he got 2 cards and paid on time, he saw a 90-point increase in 6 months. And remember, you're not disqualified forever. Bankruptcy doesn't mean you're done. Foreclosure doesn't mean you're broken. FHA loans exist to help you bounce back and make a major comeback. And if you're serious about buying, let's talk. Let's build a plan that gets you in the right position at the right moment to get you into a home. Whether you're 6 months out or 2 years away, I'm here to guide you through the process. Your comeback story starts right now. And remember, be smart, be prepared, and let's get you home.